On March 8, 2023, Silicon Valley Bank was the 16th largest bank in the United States, with over $200 billion in assets and a 40-year history of serving the tech industry's biggest names and most promising startups. Its clients included half of all venture-backed tech companies, streaming platforms, video game developers, climate tech startups, and thousands of entrepreneurs who'd built their businesses with SVB as their financial partner. The bank's CEO appeared on a conference call that day, attempting to calm nervous clients after announcing the bank had sold $21 billion in securities at a $1.8 billion loss and needed to raise $2.25 billion through an emergency stock sale. By March 9th, the bank's stock had fallen 60%, and venture capitalists were telling their portfolio companies to withdraw their money immediately. By the evening of March 9th, customers had initiated $42 billion in withdrawals, the largest bank run in American history. And by March 10th, just 48 hours after the CEO's reassuring conference call, Silicon Valley Bank was dead, seized by California regulators, its assets frozen, and its thousands of depositors facing the terrifying reality that their money might be gone forever. This wasn't supposed to be possible. Banks don't fail in 2 days. Regulators are supposed to see problems developing and intervene before collapse. And the modern financial system, with all its safeguards, deposit insurance, and stress testing, was supposed to prevent the kind of panic that destroyed banks in previous eras. But Silicon Valley Bank's collapse proved that every assumption about banking stability was wrong, that technology and social media had created new vulnerabilities that regulators hadn't imagined, and that the next banking crisis wouldn't look like previous ones because it would happen at digital speed, driven by Twitter posts and group chats rather than lines of depositors outside bank branches. Wikipedia +5. Understanding how Silicon Valley Bank collapsed requires going back to what made it unique and eventually what made it vulnerable. SVB was founded in 1983 specifically to serve the technology sector, recognizing that traditional banks didn't understand or want to work with risky startups that had no revenue, no profits, and often no real assets beyond intellectual property and venture capital backing. Silicon Valley Bank positioned itself as the financial partner for this ecosystem, offering not just banking services but connections to venture capitalists, strategic advice, and specialized lending products designed for companies that wouldn't qualify for conventional loans. The strategy was brilliant. As the tech industry exploded over the following decades, SVB grew with it, becoming by far the largest bank serving tech startups and venture capital firms. By 2021, SVB had over $211 billion in assets, up from just $71 billion in 2019, a tripling in size in just 2 years driven by the pandemic tech boom. Startups were raising record amounts of venture capital. Tech company valuations were soaring, and all that money was flowing into deposit accounts at Silicon Valley Bank because it was the preferred, sometimes the only bank that many startups and VCs used. The bank's deposits surged from about $60 billion in early 2020 to over $190 billion by the end of 2021. This sounds like success, and in some ways it was, but that explosive growth created a problem that would ultimately destroy the bank. Banks make money primarily through the spread between what they pay depositors in interest and what they earn on loans and investments. When deposits pour in faster than the bank can make loans, which is what happened to SVB during the pandemic boom, the bank needs to invest that money somewhere. SVB invested heavily in long-term securities, particularly mortgage-backed securities and U.S. Treasury bonds with durations of 10 years or more. These investments paid higher interest rates than short-term securities, which looked attractive. But they carried a risk that SVB's management either didn't understand or chose to ignore: interest rate risk. When interest rates rise, the value of existing bonds falls. This is a fundamental principle of fixed income investing. If you're holding a bond paying 1.5% interest and market rates rise to 4%, your bond is worth less because new bonds offer higher returns. On paper, this doesn't matter if you hold the bond to maturity, you'll still get your principal back plus the agreed interest. But if you need to sell the bond before maturity, perhaps because you need cash to meet deposit withdrawals, you'll have to sell at a loss because buyers won't pay full price for a bond yielding 1.5% when they can buy new bonds yielding 4%. This is exactly the trap Silicon Valley Bank walked into, and it was entirely predictable. In 2021 and early 2022, when SVB was investing deposits into long-term securities, interest rates were near zero, held there by Federal Reserve policy responding to the pandemic. But by mid-2022, inflation was surging, and the Federal Reserve began raising interest rates aggressively, eventually pushing rates from near zero to over 5% in the fastest rate hiking cycle in decades. This meant that SVB's portfolio of long-term securities, purchased when rates were low, had lost enormous value. By early 2023, SVB was sitting on roughly $17 billion in unrealized losses on its securities portfolio. As long as those losses remained unrealized, meaning the bank didn't actually sell the securities, they didn't appear on the bank's income statement and didn't technically impair the bank's capital. But everyone who understood banking knew the losses were there, a ticking time bomb waiting for the moment when the bank might need to realize them. That moment came in early March 2023, triggered by problems elsewhere in the banking system. Silvergate Bank, which specialized in serving cryptocurrency companies, announced in March that it was winding down operations after deposit outflows and mounting losses. This sent a signal to the market that banks serving specialized, potentially risky sectors might be in trouble. Investors and analysts began looking more closely at other specialized banks, and Silicon Valley Bank, with its concentration in the volatile tech sector, drew scrutiny. What they found was troubling. SVB's depositor base was highly concentrated in tech startups and venture capital firms, many of which held deposits far exceeding the $250,000 limit covered by FDIC insurance. According to some estimates, as much as 94% of SVB's deposits were uninsured, meaning depositors had enormous sums at risk if the bank failed. This concentration was the opposite of the diversification that normally protects banks. If a bank's depositors are spread across many industries and geographies, problems in one sector don't trigger bank-wide panic. But SVB's depositors were overwhelmingly in one sector, technology, and they all talked to each other, often through the same venture capital networks that had connected them to SVB in the first place. In early March, Moody's Investor Service informed SVB that it was considering a credit rating downgrade because of the bank's unrealized losses and deteriorating financial condition. This was a serious threat. A downgrade would make it more expensive for SVB to borrow money and would signal to the market that the bank was in trouble. SVB's management decided they needed to act preemptively to shore up the balance sheet before the downgrade was announced. Their solution was to sell $21 billion of available-for-sale securities, realize the $1.8 billion loss, and then raise $2.25 billion through a combination of common stock and convertible notes to rebuild capital. On paper, this plan might have worked. Realize the losses, raise capital to cover them, and move forward with a cleaner balance sheet. But the execution was catastrophic. SVB announced the security sale and capital raise on March 8, 2023, during a conference call with investors and clients. The announcement immediately triggered panic. Investors heard that the bank had just realized a massive loss and needed emergency capital. Depositors heard that their bank was in financial distress. And venture capitalists, who were already nervous about the tech sector's deterioration as interest rates rose and funding dried up, started telling their portfolio companies to withdraw funds from SVB immediately. What happened next demonstrated how social media and digital connectivity have fundamentally changed banking panics. In previous eras, a bank run required physical action. Depositors had to go to the bank during business hours, wait in line, and withdraw cash or transfer funds through processes that took time. This created natural friction that limited how fast a run could develop. But in 2023, depositors could initiate withdrawals instantly from their phones 24 hours a day. And more importantly, they could communicate with each other instantly through Twitter, group chats, and messaging apps. On March 9, 2023, as SVB's stock price collapsed 60%, panic spread through the tech ecosystem at digital speed. Venture capitalists posted on Twitter advising startups to move their money out of SVB. WhatsApp groups among founders exploded with messages about the bank's problems and advice to withdraw immediately. The information, or more accurately the panic, spread virally. Founders who might not have heard about SVB's problems through traditional media channels were alerted by texts from investors or posts from peers. And because so many startups held uninsured deposits far exceeding FDIC limits, they had rational reasons to panic. If SVB failed and you had $5 million or $50 million in deposits, you could lose everything above $250,000. The rational response was to withdraw immediately, even if your withdrawal contributed to the bank's collapse. CEO Greg Becker attempted damage control with a conference call on March 9th, urging venture capitalists and clients to stay calm. His plea had the opposite effect. The fact that the CEO felt compelled to ask clients to stay calm signaled that the situation was dire. And the call itself became material for more social media posts and messages spreading awareness that SVB was in trouble. By the end of March 9th, SVB customers had initiated $42 billion in withdrawal requests. The bank had started the day with about $175 billion in deposits. By evening, nearly a quarter of that was gone or leaving, and management expected another $100 billion in withdrawals the next day. This was unprecedented. No bank in American history had faced deposit outflows at this speed or scale. The bank run that destroyed Washington Mutual in 2008, previously the largest, had taken days to build and involved far smaller absolute amounts. SVB's run happened in hours, measured in billions per hour, facilitated by technology that allowed instant fund transfers and communication that spread panic at the speed of social media posts. The bank couldn't survive. It didn't have $142 billion in cash or liquid securities to meet those withdrawals. Much of its assets were tied up in long-term securities that, if sold, would realize massive losses exceeding the bank's capital, making it insolvent. By the morning of March 10, 2023, it was over. The California Department of Financial Protection and Innovation, SVB's primary regulator, closed the bank and appointed the FDIC as receiver. Silicon Valley Bank, which 2 days earlier had been a thriving institution and a pillar of the tech economy, was dead. The announcement sent shockwaves through the financial system and the tech industry. Thousands of startups suddenly couldn't access their operating funds. Payroll couldn't be processed. Rent couldn't be paid. Companies with millions in SVB accounts faced the possibility that those funds were gone, that they'd have to shut down or lay off employees not because their businesses had failed, but because their bank had collapsed. The broader implications were even more terrifying. If SVB could fail in 2 days, what about other banks? Were there hidden vulnerabilities elsewhere in the banking system that regulators and investors didn't know about? The answer was yes, and the proof came quickly. Signature Bank, a New York-based institution that served cryptocurrency and real estate clients, faced its own run triggered by SVB's collapse and concerns about its exposure to crypto industry problems. Signature Bank was closed by New York regulators on March 12th, just 2 days after SVB. First Republic Bank, a California institution serving wealthy clients, faced massive deposit outflows as customers panicked and withdrew funds. The bank's stock collapsed, and it required a $30 billion emergency injection from a consortium of larger banks to survive, though it would ultimately fail 2 months later. The panic was spreading beyond the specialized banks that had obvious vulnerabilities. Regional banks across the country saw their stock prices plummet as investors worried about hidden losses in their securities portfolios and the possibility of runs if depositors panicked. The banking system was experiencing a crisis of confidence reminiscent of 2008, except this one was happening faster and was driven more by social media panic than by actual insolvency. Many of the banks seeing deposit outflows and stock price collapses were actually solvent and well managed. But in a panic, solvency doesn't matter if depositors believe you're in trouble. Their withdrawals can make the belief self-fulfilling. The government response was swift and controversial. On March 12th, Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and FDIC Chair Martin Gruenberg issued a joint statement announcing that SVB's depositors would be made whole, meaning even uninsured deposits above the $250,000 limit would be protected. The FDIC would use its deposit insurance fund to cover the difference, not through a taxpayer bailout, but through assessments on other banks. Signature Bank's depositors received the same protection. The announcement was designed to stop the panic by ensuring depositors at any bank that all their funds were safe even if their bank failed. The decision was immediately attacked as a bailout of wealthy tech executives and venture capitalists who should have known better than to keep uninsured deposits in a single bank. Critics argued that depositors made poor risk management decisions and should face the consequences, that protecting uninsured deposits created moral hazard by rewarding reckless behavior. Defenders of the decision, including Yellen and Powell, argued that allowing uninsured depositors to lose money would have triggered runs on other banks as depositors everywhere rushed to move funds to the largest, safest institutions. The entire regional banking system could have collapsed, causing massive economic damage that would have hurt far more people than just tech industry insiders. The debate revealed a fundamental tension in modern banking. Deposit insurance exists to prevent runs by ensuring depositors their money is safe. But insurance only covers $250,000 per account, a limit set decades ago and never adjusted for inflation or the realities of modern business banking. Many businesses routinely maintain deposits far exceeding that limit for operational needs like payroll, rent, and supplier payments. If those deposits aren't protected when banks fail, businesses face catastrophic losses through no fault of their own. But if all deposits are protected, even those above the insurance limit, then banks can take risks knowing that government will protect their depositors, creating moral hazard. The Federal Reserve also created a new emergency lending facility, the Bank Term Funding Program, which allowed banks to borrow against their securities portfolios at par value rather than market value. This was crucial because it meant banks holding long-term securities that had lost value due to rising interest rates could still access liquidity without realizing losses. If SVB had been able to borrow from such a facility, it might not have needed to sell securities at a loss, might not have triggered the panic, and might have survived. The Fed was essentially creating the tool that could have prevented SVB's collapse, just days too late to save it. But why hadn't regulators prevented this crisis? Why didn't bank supervisors see SVB's vulnerabilities and force management to address them before disaster struck? These questions led to painful examinations of regulatory failure. The Federal Reserve issued a report in April 2023 acknowledging that supervisors had failed to appreciate the extent of SVB's vulnerabilities as the bank grew rapidly from $71 billion to over $211 billion in assets between 2019 and 2021. During that period of explosive growth, SVB wasn't subject to enhanced supervisory standards or stress testing that apply to banks over $250 billion in assets. It operated in a regulatory gap where it was too large to be treated as a small regional bank, but not quite large enough for the strictest oversight. Even more damning, the Fed's report revealed that supervisors had identified problems at SVB and issued warnings, but management had been slow to respond and supervisors hadn't escalated aggressively enough. There were matters requiring attention and matters requiring immediate attention issued to the bank in 2021 and 2022, documents warning management about interest rate risk, liquidity risk, and inadequate governance. But these warnings didn't trigger forceful action. SVB's management continued operating with the same flawed strategy, and supervisors allowed it, perhaps influenced by the bank's long track record of success and the broader assumption that bank failures were things of the past, not risks in the modern regulated financial system. The Fed's report also acknowledged its own role in creating conditions for SVB's failure. By holding interest rates near zero for years and then raising them at the fastest pace in decades, the Fed created exactly the scenario that would destroy banks holding long-term securities. This wasn't hidden or surprising. Everyone in banking knew that rising rates would hurt the value of existing bonds. But the speed and magnitude of the Fed's rate increases, from 0% to over 5% in roughly a year, created losses that even prudent risk management might not have fully hedged against. And it exposed banks like SVB that had bet incorrectly on rates staying low. Silicon Valley Bank's management bore primary responsibility for the failure. The Fed's report explicitly blamed SVB's senior management for mismanaging interest rate risk and the board of directors for failing to provide adequate oversight. But the report also forced uncomfortable questions about whether the entire regulatory framework was adequate for modern banking, where risks can develop quickly, panics can spread at digital speed, and concentrated depositor bases in specific industries create vulnerabilities that traditional bank supervision wasn't designed to monitor. The longer-term implications of SVB's collapse are still unfolding. Thousands of tech startups faced liquidity crunches even after deposits were guaranteed, as the process of transferring funds from the failed bank took weeks. Some companies missed payroll or had to delay payments to suppliers. Venture capital funding, already declining due to higher interest rates, tightened further as investors became more risk-averse and startups more conservative about cash management. Climate tech startups, which had been among SVB's major clients, faced particular difficulties accessing credit and banking services as other banks were hesitant to fill the gap left by SVB's failure. First Citizens Bank eventually acquired SVB's assets and deposits in late March 2023, but the acquired institution was a shell of what SVB had been. The unique culture, relationships, and specialized knowledge that had made SVB the preferred bank of the tech industry were lost. And the industry itself became more cautious, diversifying deposits across multiple institutions and keeping more cash in treasury bills or money market funds rather than bank deposits. This made individual companies safer but reduced deposits available to banks for lending, potentially constraining credit availability. The panic also revealed how social media has fundamentally changed financial stability. In previous bank runs, panic spread through word of mouth, news reports, and visible lines of depositors outside branches. Today, panic spreads through Twitter posts, group chats, and viral messages that can reach thousands or millions in minutes. The traditional tools regulators use to slow or stop bank runs, like temporarily closing banks for a bank holiday or limiting withdrawal amounts, don't work in a digital age where the run happens before regulators even know there's a problem. By the time SVB's CEO was on a conference call asking clients to stay calm, the run was already irreversible because social media had spread panic faster than any official communication could counter it. This creates a new vulnerability in banking that regulators are only beginning to grapple with. Banks are fragile institutions by design, operating with leverage and depending on depositor confidence. When confidence breaks, the bank fails regardless of its actual financial condition. And in the social media age, confidence can break nearly instantly based on rumors, misunderstandings, or deliberate misinformation. A Twitter post claiming that a bank is in trouble, even if false, can trigger withdrawals that make the claim self-fulfilling. This happened to First Republic Bank after SVB's collapse, when social media speculation about its exposure and depositor concentration caused runs that ultimately contributed to its failure despite the bank being well capitalized initially. The question facing regulators is whether banking is even possible under these conditions. If a bank can fail in 48 hours because of social media panic, regardless of its actual financial health, then the entire model of fractional reserve banking becomes questionable. Banks can't hold enough liquid assets to meet all depositors simultaneously. That's inherent in how banking works. Banks borrow short through deposits and lend long through mortgages and business loans. This maturity transformation is profitable and economically valuable, allowing long-term investments to be financed by short-term savings. But it only works if depositors don't all demand their money simultaneously. When they do, even sound banks fail. Deposit insurance was supposed to solve this problem by ensuring depositors that their money is safe up to the insurance limit, removing the incentive to run. But SVB revealed that deposit insurance doesn't work when most deposits exceed the insured amount. And extending insurance to all deposits, as the government effectively did for SVB and Signature Bank, creates enormous moral hazard. If all deposits are insured regardless of amount, why would large depositors ever pay attention to their bank's financial health? They have no reason to discipline banks through the threat of withdrawal because government guarantees they'll be made whole regardless of how recklessly their bank operates. The banking industry's response has been to argue for higher deposit insurance limits or even unlimited insurance for business accounts, claiming that the current system is unworkable for modern commerce. Critics counter that unlimited insurance is a blank check for risky banking behavior, allowing institutions to gamble with federally insured deposits, knowing that losses will be socialized while profits remain private. The debate continues with no clear resolution because both sides are correct. Business banking does require deposits above current insurance limits, but unlimited insurance does create unacceptable moral hazard. What makes SVB's collapse particularly significant is that it wasn't supposed to happen. This wasn't 2008 when banks had loaded up on subprime mortgages and complex derivatives that nobody understood. SVB's assets were mostly U.S. Treasury bonds and agency mortgage-backed securities, among the safest investments in the world. The bank didn't fail because of fraud or criminality or even particularly reckless lending. It failed because of poor risk management, concentrated deposits, and a panic that spread faster than anyone was prepared to handle. If this bank could fail under these circumstances, then potentially any bank could fail given the right combination of interest rate movements, depositor concentration, and social media panic. The banking panic no one was ready for wasn't just about SVB. It was about discovering that the modern financial system, despite all its regulations, stress tests, and safeguards, remains fundamentally fragile. The tools regulators developed after 2008 were designed to prevent the last crisis, banks loading up on risky mortgages and derivatives. They weren't designed to prevent the next crisis, which turned out to be a good bank destroyed by interest rate risk and social media accelerated panic. This pattern repeats throughout financial history. Each crisis teaches lessons and prompts reforms designed to prevent that specific type of crisis from happening again. But the next crisis is always different, exploiting vulnerabilities that the last round of reforms didn't address. Silicon Valley Bank's collapse was a warning that should have prompted fundamental rethinking of how banking works in the digital age. Instead, the response was largely defensive. Guarantee the deposits to stop the panic, create an emergency lending facility to help other banks with similar problems, and move on assuming the system is stable. But the underlying vulnerabilities remain. Banks still hold long-term securities that lose value when rates rise. Depositors can still withdraw billions in hours through digital channels. Social media can still spread panic faster than regulators can respond. And the concentration of deposits above insurance limits in business accounts means that a large portion of the banking system's funding is essentially uninsured and subject to runs if confidence breaks. The tech industry, which had relied on SVB for decades and suffered severe disruptions from its failure, learned its own lessons. Startups now diversify deposits across multiple banks, keep more cash and treasury bills, and maintain relationships with multiple financial institutions. This makes individual companies more resilient, but makes the banking system more fragile by reducing deposit stability. When every depositor is ready to move money, instantly at the first sign of trouble, banks face constant risk of runs. The result could be a migration away from traditional banking toward either larger, too-big-to-fail institutions that depositors believe will always be bailed out, or toward non-bank alternatives like money market funds and treasury bills that don't offer the same credit creation and maturity transformation that makes banking economically valuable. The final irony of Silicon Valley Bank's collapse is that it was preventable at multiple levels. If management had hedged interest rate risk properly, the securities losses wouldn't have occurred. If regulators had enforced stronger risk management as the bank grew, the vulnerabilities would have been addressed. If the CEO hadn't made the panicked announcement on March 8th trying to raise capital, the run might never have started. If social media hadn't spread panic so quickly, depositors might have stayed calm long enough for a rescue to be organized. And if deposit insurance covered business accounts adequately, depositors wouldn't have had incentives to run. But none of these preventive measures were in place. So the panic happened, the bank failed in record time, and the financial system discovered it was far less stable than anyone had believed. Understanding the banking panic no one was ready for means understanding that the next financial crisis won't look like the last one, that technology has created vulnerabilities faster than regulations can adapt, and that confidence remains the foundation of banking no matter how sophisticated the financial system becomes. Silicon Valley Bank's 40-year history ended in 48 hours because confidence broke at digital speed. The bank that had financed countless technological innovations became the victim of the very digital connectivity it had helped finance, destroyed by instant communication that turned concern into panic, and panic into the largest bank run in history. If this gave you a new perspective, hit subscribe. History doesn't repeat, but banking panics always do. And the next one, like SVB's collapse, will happen faster than you think, driven by technologies and communication channels that regulators don't understand and can't control. The question isn't whether there will be another banking panic, it's whether you'll recognize it starting before everyone else does, before the social media posts spread, before the withdrawals begin, and before the banks close their doors for the last time. Because in the age of digital banking and social media, the panic happens so fast that by the time you see the warning signs, it's already too late.